A few years ago, buying a car felt simple. You walked into a dealership, looked at a shiny new car, the salesperson smiled, and then came the magic sentence. Your monthly payment would only be $620. And suddenly, a car that costs tens of thousands of dollars doesn't feel expensive anymore because your brain isn't thinking about the total price. It's thinking about the monthly payment. And that single psychological trick is exactly why millions of people end up trapped in car loans they never truly understood. But recently, new car loan rules started changing. Higher down payments, stricter approvals, higher interest rates, longer loan terms, and a lot of people got frustrated because many believe these rules are making life harder. But here's the uncomfortable truth. What if these new rules are actually exposing a financial trap that already existed? A trap millions of middle-class people walk into willingly, without even realizing it, because this isn't really about cars. It's about how money quietly controls human behavior. And once you see it, you'll never look at car loans the same way again. Let's imagine two people, Jake and Ryan. Both are 29 years old. Both have decent jobs. Both make about the same income. And both decide they finally deserve a new car. Now, this is where psychology enters the picture. Jake looks at the total cost. Ryan looks at the monthly payment. That tiny difference changes everything. The dealership tells Ryan, "You can drive this car home today for just $640 a month." Just that word is dangerous because the human brain is terrible at understanding large future costs. We care more about what hurts today, not what slowly drains us over the next 6 years. So Ryan signs the papers, and for the first few weeks, life feels amazing. The new car smell, friends impressed, photos on Instagram, compliments from coworkers. He feels successful, but then something strange starts happening. Every month, his paycheck arrives and disappears faster than before. Not because of one giant problem, but because car ownership quietly creates invisible expenses. Gas, insurance, maintenance, repairs, registration fees, parking, car washes, and suddenly one financial decision starts affecting every other financial decision in his life. Because debt changes how people behave. When your monthly obligations increase, your freedom decreases. You become more careful at work, more afraid to take risks, less likely to quit a toxic job, less able to invest, less financially flexible. The loan doesn't just take your money, it starts controlling your decisions. And banks understand this perfectly. That's why modern financing focuses heavily on monthly affordability, not total affordability. Because if people focused on the total cost, many of them would walk away. Imagine someone tells you, "This car costs $48,000. Painful. But if they say, "It's only $620 a month, suddenly your brain relaxes. Same car, different framing. This is called payment psychology, and companies use it everywhere. Phones, furniture, subscriptions, luxury products. Everything becomes affordable when it's divided into smaller monthly payments. But financially, small monthly payments can create massive long-term damage, especially when the thing you're buying loses value quickly. And cars lose value incredibly fast. The moment most new cars leave the dealership, their value drops immediately. Imagine borrowing money for something that becomes less valuable every single day. That's what many car loans are. And yet emotionally, cars don't feel like financial liabilities. They feel like status, identity, achievement. Because humans are emotional buyers pretending to be logical thinkers. This is where the new car loan rules become interesting. Because stricter loan requirements force people to pause. And pausing is dangerous for impulse decisions. Think about it. If someone can instantly finance a car with little money down, they focus on emotion. But if lenders suddenly require larger down payments, better credit, more documentation, people start calculating. And calculation kills emotional excitement. That's why stricter lending often feels unfair, because it interrupts emotional spending. Now, of course, not all car loans are bad. That's important. A car can genuinely improve your life. It can save time, help you commute, increase safety, create work opportunities, support your family. The problem starts when people buy cars to signal success they haven't actually built yet. Because modern society rewards looking rich more than becoming wealthy. And there's a massive difference between those two things. A rich-looking person might drive a luxury SUV while secretly stressed every month about bills. A wealthy person may drive a normal car while owning investments quietly growing in the background. One focuses on appearance. The other focuses on freedom. And social media has made this problem even worse. Everywhere you look, people are showing upgraded lifestyles, new cars, luxury apartments, road trips, perfect photos. What you don't see is the financial pressure behind many of those pictures. The anxiety, the debt, the missed investments, the pressure to maintain an image. Because once people upgrade publicly, downgrading becomes emotionally painful. This creates something psychologists call the lifestyle trap. Your expenses rise, and then your identity becomes attached to them. Now, you don't just own the car owns your financial behavior. And here's the crazy part. Most people don't notice this happening. Because financially destructive decisions rarely feel destructive in the beginning. They feel exciting, comfortable, rewarding. That's why humans struggle with long-term wealth building. Our brains are built for immediate rewards, not future optimization. Saving money feels boring. Investing feels slow, but buying something exciting creates instant emotional satisfaction. And companies compete aggressively for your attention because attention creates spending. Spending creates debt. Debt creates long-term customers. That's why financing has become one of the most powerful business models in the world. The easier borrowing becomes, the easier consumption becomes. And the easier consumption becomes, the harder wealth building becomes. Now here's something most people never calculate. Opportunity cost. Let's say someone spends $700 a month on a car payment for 6 years. That money isn't just disappearing. It's also money that could have been invested, compounded, grown. Future wealth is often destroyed by present comfort. Not by huge mistakes, but by small, repeated decisions. And this is what separates many wealthy people from average earners. Wealthy people often delay visible rewards. Average consumers often finance visible rewards immediately. One builds assets first. The other buys symbols first. And symbols are expensive. There's another psychological trick hidden inside car loans. Humans adapt very quickly. The first month with a new car feels incredible. By month 6, normal. By year 2, it's just transportation. This is called hedonic adaptation. People quickly get used to upgrades, which means the emotional happiness fades, while the payments continue. And then something dangerous happens. People chase the next upgrade. A bigger car, a newer model, more luxury, and the cycle repeats. That's why some people earning 6 figures still feel financially trapped. Their income rises, but their financed lifestyle rises even faster. And no matter how much they earn, they never build actual freedom. Because freedom comes from owning assets, not financing liabilities. And this is where the smartest financial shift happens. The moment someone stops asking, "What monthly payment can I afford?" and starts asking, "What future am I sacrificing for this purchase?" everything changes. Because money is not just math. It's behavior. Every financial decision is really a life decision in disguise. A loan commits your future income. An investment creates future options. And financially successful people understand one simple principle. Future flexibility is valuable. Now, does this mean nobody should buy a car? Of course not. That's not realistic. The real lesson is awareness. A car should support your financial life, not dominate it. Before taking on a car loan, most people should ask themselves a few uncomfortable questions. Am I buying this for utility or validation? Can I truly afford this? Or only the monthly payment? Will this purchase increase my freedom or reduce it? And most importantly, what could this money become if invested elsewhere? Because the hardest truth about money is this: every purchase has a hidden future cost. Not just the price today, but the opportunities you lose tomorrow. And the people who build long-term wealth understand delayed gratification better than almost everyone else. They know that looking wealthy and becoming wealthy are completely different games. One gets attention today, the other creates freedom later. The new car loan rules are not just financial regulations. They reveal something much deeper about modern life. We live in a world designed to make spending feel easy and patience feel difficult. A world where people are encouraged to consume first and think later. But wealth rarely grows from emotional decisions. It usually grows quietly, slowly, patiently, and often invisibly. That's why many financially successful people don't look impressive at first. Because real wealth is often hidden. It's the freedom to say no, freedom to leave bad jobs, freedom to survive emergencies, freedom to invest, freedom to choose your life without fear. And ironically, many people sacrifice that freedom just to appear successful for a few moments online. So the next time you hear, "It's only $620 a month," pause for a second. Because maybe the real question isn't whether you can buy the car. Maybe the real question is, what is this decision quietly costing your future? And once you understand that, you stop thinking like a consumer and start thinking like someone building wealth.